Set up for the big week ahead of earnings outside of the big banks, starting with Tesla reporting Wednesday. Bill, you own it.
Yeah, I'm really excited for this earnings report. I'm going to maybe hear more about the charging stations with GM and Ford. We're looking for a significant increase in revenues as well. I think $24.7 billion compared to the previous report, $23 billion. The stock's just been on an absolute tear. It's definitely one of those stocks, and Joe and I've talked about before, where it's you got to treat it like a commodity. This when a lot of volatility. I watch it against copper, and copper has been lagging higher quite a bit. So once we get past earnings season, if they don't disappoint, I think a lot of that ties to China. There's a lot of positive momentum around it, and I'm expecting this thing to really get out above 300. All
right, certainly something to watch. All right, one more for Bill. Stanley bought AMD at 59 bucks. How long should he ride the rainbow?
Well, first off, Stanley, congratulations. What a buy at $59. We own AMD, and I'm still very bullish on the artificial intelligence space. I think that no one's really next to NVIDIA, but if anybody's going to surprise and close that gap, it really could be AMD. You're starting to see the AI really kind of trickle out everywhere. NVIDIA making a move on Recursion, pharmaceutical company. You're seeing Schlumberger talk with Petrobras about implementing their machine learning and AI. This space is going to continue to expand. AMD is going to be right in the middle of it, but here's the caveat. You do not want to see it break below $100 to $105 there. That's going to be the huge support. We get below there, I'd be worried.
All right, coming up on half, we got the final trades. Jamie Dimon saying consumer balance sheets, they remain healthy. Consumers are spending. It is slowing down, but that's not a complete shock, Bill.
Yeah, I think these were upbeat comments from Dimon, and we're far away from what we heard a couple months back, where the hurricane was coming. I think he's on board with seeing a soft landing. We had the Michigan consumer data today that was actually better than expected. I'm looking at the loan loss provisions too from J.P. Morgan. If you strip out First Republic, I think they're $100 billion lower than they were a year ago. So I think that says something. I look at that speaking volumes to where they think the trajectory of the economy is going.
So wait, you say if you strip out First Republic, isn't it important that if you include First Republic, the beat just gets better?
Well, yes. They have $1.5 billion in loan loss provisions. 1.2 of that was set aside from First Republic. And then year over year, they were at $438 billion a year ago without First Republic. So you stripped out, what they had before was $100 billion less. So their bank is healthy, and the trajectory of the economy, that tells me, is coupled with Dimon's comments.
No, let's not dismiss.
I want to bounce something off, Bill. I want to bounce something off, if you don't mind. We have a chart right here, just over this week alone. So, looking at the NASDAQ 100 this week, up 4.5%. But you look at some other much higher valuation areas of tech, outperforming, at least in some cases. See the BOTZ ETF, 4P of 40 times. See the cloud computing ETF, 4P of 59 times. Outperforming the NASDAQ 100. What does that tell you about the whole valuation story we've been talking about all year, Bill?
I think Jenny's onto something, tying that what you're saying about valuation is that the guidance and the expectations have been lower. And that's been a theme for the way I invested all year. And the reality is, you take a step back, this is a bull market. It's been a bull market, and it's fun to see this in a bull market. This is exciting. And I think that we're going to see earnings come in, continue to be solid, and those lower bars are going to be beaten. Yes, some of the valuations are high, but I think they're going to meet those with revenue. And one of the things that I think is going to be very important, and Jenny pointed to, was the interest rates. And as a futures trader, I'm also watching interest rates and trading the belly of the curve and looking at where things are. We had a massive flush down in prices of treasuries to start this month out. And that I think is the start of a capitulation in the treasury market. So, and the reason being, if you go back to last month, when the debt ceiling was fixed, they did T-bills. They issued about, 700, 800 billion in T-bills. Now they're going to issue in longer than 1 year in the notes and bonds. The market priced that in very quickly. If that happens, with the way it's priced in, and inflation starts coming down, we're going to see the treasury market rise, meaning yields are coming down, and that's going to become a tailwind to earnings. It's going to become a tailwind to the market, and that's why I think this bull market is just getting started, and it's a fun thing to see.
And if we end the year at this level, to me, that's an enormous victory. And that's the gift that his brighter second half gives us, is the opportunity to keep such a nice return on the year.
And I think we could be at record highs before the end of the year. I don't think it's just holding here.
Record highs, it's like what, 2-3% more?
Yeah, but 5-10%.
It's not 17.
Yeah, it's not
7%.
And we've become really comfortable with brighter
for the
outlook. we become, everything's like, oh, brighter outlook, up 35%. Like, no.
But analysts are still very negative, and I see that becoming a tailwind. So
that's a great point.
I've been extremely bullish this year, and I'm a realist, though. I do think that we are starting to hit some point of exhaustion. I think even on this leg, it's just breaking out, so there's some room to go here. What I'm looking at is the seasonality right now at the end of June through the end of July. The market has been up 15 in the last 15 years, and that S&P's averaged 3 or 4%. But when we go to August and October, it's a cooling off period. So I think there's going to be a correction that happens in August, October. Now, if it happens in August, it could happen in the S&P 4600, 4650 area, and it could be a 5% correction. If it happens in October, it could be from record highs. It could be more of a 10% correction. But I expect all those bears, all those have been negative this market, they're going to use that as an opportunity to turn bullish again if they're smart.
Okay.
And that's going to become the next tailwind for the quarter four, what could be a Christmas rally. And I think we finished the year very strong. The way things are setting up, the headwind would be, though, is if the base comparisons for inflation, they're going to start moving lower into the second half of the year, and inflation could become a headwind there. That's one of my concerns.
Yeah, and getting from that 3% down to 2%, like,
that's the hard part.
That's
it's
the
like
hard
losing the
part.
last 10 pounds. UPS actually put out some data a couple years ago. They moved 3% of global GDP, about 6% of U.S. GDP.
There's a problem.
Those figures released a couple years ago, but you'd imagine it stays in about the same time frame. You guys worried at all what this could mean for the broader economy, also potentially consumer spending? If people don't feel like they can get their e-commerce, do they still buy it?
If anything, that could actually become, consumer spending down is a tailwind to what the Fed's trying to do. And it lowers that consumer demand with the headwinds of some of the credit card debt rising. So I think, if anything, it's bad for slowing the economy in general, but it could be a tailwind for what the Fed's trying to accomplish. And I think that's good for the market.
I had a bigger macro kind of thought on it.
Remember, UNH was the first person to flag that more seniors are getting operations. They thought it would hit margins. And then you see them turn around just a few weeks later, raise their EPS guidance. Bill, I see you nod.
We own UNH, and it's been it's a staple within our portfolio. One of the stocks we like. Last year it performed really well. So the fact that Jason cited, he's right. It's down 7-8% this year, but that's coming off of a very strong year last year relative to the rest of the market. And so they lowered that bar. The pickleball narrative lowered the bar for what these operation costs that we're going to see, and their revenue was up 13%, costs were up 16%, and the medical ratio was 83% compared to 81% last year, but it was in line with what the analysts were expecting. So I think the market just is really liking this.
The reality is 2023 for healthcare is not 2022. We own 23 names.